Welcome to another bar walkthrough video from SuperfastCPA. I'm Logan, and in today's video, we are going to be going over bar area 2. This is section D. This is an application topic. Use a given fair value measurement of a share-based payment arrangement classified as equity to prepare journal entries to recognize compensation cost. And we're going to be doing that the Superfast CPA way, which is diving straight into the questions to learn the material. Now, if you don't know much about our strategies, make sure you go to SuperfastCPA.com and sign up for our free 1-hour webinar training. In that 1 hour, we will teach you the key ingredients to passing the CPA exam so you don't waste months or even years of your time failing exams. And then after you watch that, you're going to want to learn more, so make sure you also check out becoming a Superfast CPA Pro member. Pro members get access to the full versions of these videos. So in today's video on YouTube, we're only going to be going over 5 questions, but Superfast CPA Pro members will get access to the full 10-question version when we post it in the member forum. So if you like this and you like our other products and our other videos, make sure you check out becoming a Superfast CPA Pro member. Now with all that, let's dive straight into the questions. All right, here we are at question 1, and something I always like to point out when it's possible is you want to read the last sentence of a question first. This is a very good strategy, especially for exam day, because you have no idea what you're going to be seeing on the exam, and reading the last sentence frequently will give you context for what the question is about, what the question is even asking you to do. So read that first, then read the rest of the question so that you have an idea of what you're looking for throughout the question. You'll be a little bit faster by doing that. So let's do that here. What is the total compensation expense Flax Inc. should recognize over the entire vesting period for this grant? Let's go up to the top. On January 1st, year 1, Flax Inc. granted 5,000 stock options to key employees. Each option allows the holder to purchase 1 share of Flax stock at $25 per share. The options vest evenly over 4 years and become exercisable on January 1st, year 5. On the grant date, the fair value of each option was estimated at $6 using an option pricing model. So again, what is the total compensation expense that they're going to recognize over the vesting period? Now, if you have any idea how to do this, then you might know the correct answer. But if you've never seen this before, or if you don't really know what we're talking about, that's okay. We are using this question and the following questions to learn what we're supposed to know for this blueprint topic. So let's go ahead and take a look at the explanation to learn how to do this. All right, here we are at the answer. C, $30,000 is the total compensation expense. So let's go through this. It's very simple. When stock options are classified as equity, the total compensation cost is measured based on the grant date fair value, not the exercise price or when the options become exercisable. The total compensation expense is calculated as the 5,000 options multiplied by the $6 fair value that we had on the grant date. So that's $30,000 of total compensation expense that's going to be recognized over the course of the vesting period. Again, that's the amount that's going to be recognized over the course of the whole vesting period. And normally you actually only recognize a portion of it each year, but this question was just asking for the full compensation cost that's going to be over the course of the vesting period. So we're going to learn a little bit more about how to break that up in the next questions. But again, the very simple basic idea here is to figure out the compensation cost when it comes to these stock options that are classified as equity. You just take the fair value at the grant date and multiply it by the amount of options. It's very simple. Now let's go to the next question. All right, here we are at question 2. Let's read the last sentence first again. What amount of compensation expense should Loma recognize in year 2? Let's go up to the top. On January 1st, year 1, Loma Corp granted 12,000 stock options to employees. Each option allows the employee to purchase 1 share of Loma stock at $20 per share. The options vest evenly over 4 years and become exercisable on January 1st, year 5. On the grant date, the fair value of each option was estimated to be $5. So again, what is the amount of compensation expense that they're going to recognize in year 2? So we talked a bit about this a little bit in question 1, and so you should know how to calculate the total compensation expense, and it's pretty simple to figure out how much is it in each year. So pause the video, think about what we just learned, give it your best shot, and when you're ready, come back, we'll look at the answer together. All right, here we are at the answer. B, $15,000 is how much compensation expense they're going to recognize in year 2. So let's go through this. Again, very simple. This is basically just the next step after what we did in question 1. For equity classified stock options, compensation expense is based on the grant date fair value, and it is recognized over the vesting period. So again, step 1, you calculate the total compensation expense, which is just the 12,000 options multiplied by the $5 fair value at the grant date, and that's $60,000. Now we can determine the annual expense, and it's really easy, basically very similar to straight line depreciation. You just take the $60,000, divide it by the 4 years that it's going to vest over, and that's $60,000 divided by 4 equaling $15,000 per year. So they should recognize $15,000 of compensation expense in year 2, just like they did in year 1, and that's the same thing they're going to do in year 3 and 4 as well. So very simple. We basically learned the first step in question 1. Now we learned the second step in question 2. Now let's go to the next question. All right, here we are at question 3. What amount of total compensation expense should Glacier recognize in year 3? Let's go to the top. On January 1st, year 1, Glacier Corp granted 12,000 stock options to employees. Each option permits the purchase of one share at $22 per share. The options vest evenly over 4 years, and the grant date fair value of each option was $6. On January 1st, year 2, Glacier granted an additional 10,000 stock options to employees. These options also vest evenly over 4 years, and the grant date fair value of each option was $7.20. So again, what's the total compensation expense that they're going to recognize in year 3? Pause the video, think about this. We've learned how to do this already. You just have 2 stock options that you're dealing with in this case, but it's really not too difficult. So pause the video, do this how you think you would do it, and when you're ready, come back, we'll look at the answer together. Okay, here we are. The answer is A, $36,000. This is pretty simple, basically just taking what we did in question 2 and doing it twice. Each stock option grant must be accounted for separately based on its own grant date, fair value, and vesting schedule. So the first grant was on January 1st, year 1. They had 12,000 options that they granted, and you multiply that by the $6 of the fair value on the grant date, and that's $72,000 of total compensation expense. Divide that by the 4 years that they're going to have for vesting, and that's $18,000 per year. So in year 3, just like in all of the 4 years that it's going to be vesting, it's an $18,000 compensation expense. Now we do the second grant. That had 10,000 options, and that was multiplied by $7.20 of fair value for each of those, and it ends up being the same. $72,000 of total compensation. Same thing, divided by 4 years, so it's $18,000 again. So $18,000 in year 3 for the second grant as well. So $18,000 plus $18,000 gives you $36,000 of total compensation expense in year 3 between the 2 grants. So again, just kind of doubling what we did in question 2. Now let's go to the next question. All right, here we are at question 4, and this is where things start to get a little bit more complicated. So we're going to take everything we've learned so far and try to apply it to this question, but we're going to learn a lot more in this one. So let's go through it. By what net amount did stockholders' equity increase as a result of both the stock option grant and the later exercise? Let's go up to the top. On January 1st, year 1, Bravo Corp granted 10,000 stock options to employees. Each option allows the employee to purchase one share of common stock at $20 per share. The options vest evenly over 2 years. The grant date fair value of each option was $5. All options were exercised in full on January 1st, year 3, when the stock's market price was $30 per share. The par value of Bravo stock is $1 per share. So again, what net amount did stockholders' equity increase by as a result of both the stock option grant and the later exercise? Now, based on everything we've learned so far, you might know how to do some of this, but this is a fairly new question where there's a lot of new elements. So if you don't know how this works, that's okay. But if you want to give it a try, go ahead. And when you're ready, come back. We'll look at the answer together. Okay, here we are. The answer is B, $200,000. So now that we can see the answer is $200,000, let's scroll down just a little bit more to see the full explanation a little bit better. There we go. Okay, so this is a much more involved question, so we're going to go through it piece by piece. So the first step or the first phase is we have to look at what happens when it's granted and during those vesting years, during years 1 and 2. Each year, Bravo recognized compensation expense, which we've been learning about in the other questions. They debit compensation expense. That makes sense. $25,000 each year. So $25,000 in year 1, $25,000 in year 2. And the opposite side of that is a credit to additional paid-in capital stock options. So each year, year 1 and 2, they're doing this journal entry. And so over the course of the 2 years, they have a total compensation expense of $50,000 and a total APIC stock options or additional paid-in capital stock options of $50,000. And how do those affect equity? Now, as far as it goes for this topic, from what I saw in the AI CPA questions that I had access to, the way you do it is you reduce the equity for the compensation expense and you increase the equity for the additional paid-in capital stock options, which that makes sense. The thing that I was a little bit surprised by, which I don't know why I was surprised, but total compensation expense does reduce the retained earnings, so therefore it reduces the equity. So the net change in stockholders' equity from these journal entries is 0. The stockholders' equity doesn't change overall from this. One equity account goes down, which is the retained earnings, and another one goes up, which is the APIC stock options, but they offset. There's no net increase or decrease in total stockholders' equity from the grant and the vesting. So over the first 2 years, stockholders' equity doesn't change specifically from the grant and from the vesting. So now let's go to phase 2. The second step, where they exercise the options in year 3. This journal entry is about exercising the options, so it's 10,000 options exercised at $20 per option. And again, that was given to us at the beginning. They were told that they could exercise these options for $20 per share. So it's cash. They are getting cash from the people exercising their options. They're paying for the options. So cash of $200,000, that increases assets, but it has no effect on equity because it's just cash. And then you debit APIC for the stock options that they had. So these stock options up here that we've been crediting to increase equity to be prepared for when they exercise these stock options, those are now going to go down by debiting them. So that decreases equity by the $50,000 from up here. And then we credit common stock for $10,000, which is the 10,000 shares multiplied by the $1 par value. That increases equity as well. And then there's a plug down here where we credit additional paid-in capital for common stock, or you might see something slightly different here. But again, you credit some kind of paid-in capital, $240,000, and that's the plug. because you look up here, $200,000 plus $50,000, that's $250,000. The common stock was $1 par, so that's $10,000. So the plug is APIC common stock $240,000. So this last piece is a plug. So that also increases equity. So $240,000 increase to equity, $10,000 increase to equity, $50,000 decrease to equity. So you add up all that together, and that's a net increase in stockholders' equity of $200,000 from them exercising the options. Even though cash was received, cash affects assets, not equity directly. The equity increase comes from issuing stock above par value minus the reduction in the stock option APIC. So again, this question is a little bit more complicated, and I wanted to show you the journal entries for what's happening when it's granted during the vesting period, and then what happens when they exercise the options. So again, compensation expense over the vesting period, and you're also crediting APIC stock options to build up and to be prepared for giving those stock options out when they are exercised. And then on the exercise date, you debit cash for however much these options were able to be purchased for. You debit the APIC stock options from what you were building up over the vesting period. You credit common stock for the par value of those shares. And then in this case, you would credit APIC common stock because that's the plug. It might not always look like this, so you want to make sure that you pay attention just in case for some reason this actually needs to be a debit to kind of even things out. But probably most likely what you'll see on the exam is something similar to this, most likely if you see something like this. So again, that is how you do the journal entries for the grant, for the vesting, and for the exercise of the options and how it affects equity over that time. Now let's go to the next question. All right, here we are at question 5. What journal entry would Westlake LLC record on December 31st, year 1? Let's go up to the top. On January 1st, year 1, Westlake LLC granted a key employee a profits interest reward representing a 5% share of future profits and appreciation in the value of the LLC with no rights to existing capital or retained earnings. The award vests after 3 years of continued service. On December 31st, year 1, the award is not yet vested, and the fair value of the profits interest award is estimated to be $45,000. So again, what journal entry are they going to be making? Now, based on what we've seen so far, you might have a decent idea of what to do here. This is a little bit different because it's a profits interest award, not a share-based award, but it's pretty similar to what we've talked about before. So think about what we've learned, give it a good guess, and when you're ready to come back, we'll look at the answer together. All right, here we are. The answer is A. You debit compensation expense for $15,000. You credit members' capital for $15,000. So this is pretty similar to what we've seen so far. So let's scroll down just a little bit so we can see the explanation a little bit more easily. Okay, what is a profits interest award? That's something that we need to understand because this is a kind of smaller piece of this blueprint topic, but it's still something that you might see. So let's understand it here. A profits interest award is a form of equity-based compensation in a partnership or an LLC. Instead of granting ownership in existing capital, like a capital interest, like what we've been talking about throughout the rest of this video, the award gives the employee a right to share in future profits and appreciation, but not in the current value of the business. In other words, the employee benefits only if the entity grows in value after the grant date. These are most commonly used in LLCs and taxed under partnership rules. So that's what the idea is. That's what it is. So let's go through how this works. Although it's not a corporate stock option like we've been talking about, a profits interest can still be considered a share-based payment arrangement under US GAAP if it meets the definition of equity compensation. And we're not going to dive too deep into that, but you might see a question like this where it's implied that this is equity compensation. If the award is tied to service and has a determinable fair value, the entity should generally recognize compensation expense over the vesting period, just like with stock options. So let's go through that here. It's pretty simple. Take the total estimated value, which was $45,000, and that was given at the very end of the question. Vesting period is 3 years. Year 1 expense would be the $45,000 divided by 3, $15,000 of compensation expense. So very similarly to what we've done before, you debit compensation expense for $15,000. That reduces equity via retained earnings. And then you credit members' capital, which is a little bit different than what you saw in the other questions. The key here is that you want to know that you debit compensation expense and you credit the capital for $15,000 as well, and that is going to increase and decrease equity, or basically have a net zero effect on equity. Just like stock options, this is an equity-based award. There's no liability, and the expense is accrued ratably, or again, even, it's $15,000 each year. It's evenly over the years, over the service period. So again, this is something that's a little bit smaller. It's less likely to show up on the exam compared to everything else that we've been talking about, but you still might see something about a profit interest award, and it's treated pretty similarly as far as the CPA exam goes to what we've talked about in the rest of this video. So with all that, we've gone over the first 5 questions. Now, before we do anything else, let's do one more part of the SuperFast CPA process called pillar topics. Now, the idea behind pillar topics is as you're going through the questions to learn the material in your review course, you're going to notice the things that keep popping up in the questions. You've seen 2 or 3 or 4 questions trying to teach you about how to calculate compensation expense for each year, or again, how much compensation expense is going to be recognized each year. Again, you see these things throughout the questions and you notice them, and so you take your time and you write these key things that you learned from the questions as your pillar topics. Again, these are the things that you saw the most frequently throughout the questions. And as you're doing this each day, you are building your own personal repository of the most important things you learned from the questions in your review course so that you know and have an idea of what is most important to know when you go to the exam. So let's go ahead and take a look at the pillar topics for this video. All right, here we are at the pillar topics. Let's just dive straight in. Total compensation expense for stock options is based on the grant date fair value. It's calculated as the number of options multiplied by the fair value per option, regardless of exercise price or market value. And by the way, that first pillar topic, if you don't remember anything else from this video, which I hope you do, but if you don't remember anything else, this is the key that I would say you need to know from all this whole video is that first one, that the simple thing that you need to know is that the stock options is based on the grant date fair value. That's the number that it's all going to be based off of for the compensation expense. Now let's talk about compensation expense. Compensation expense for equity classified stock options is recognized evenly over the vesting period. Each year, an equal portion of the total compensation expense is recorded until vesting is complete. Now let's talk about the next one. Granting and vesting of stock options causes no net change in stockholders' equity. Compensation expense reduces retained earnings, but APIC increases by the same amount. And then you'll remember that we also talked about the journal entry for when it's exercised, and that was a little bit different. Now let's go to the final pillar topic. Profits, interest, awards in partnerships are similar to share-based payments and are expensed over the vesting period if fair value is measurable. So similar to what we talked about in the whole rest of the video, profits, interest, awards can be treated very similarly as far as compensation expense each year and so on. So again, those are the basic ideas that we pulled out. Again, you could have pulled out slightly different pillar topics, or you might have written it differently, but that's the idea behind pillar topics. You're pulling out the key things that you learned from the questions. Now, with all that, we've done everything for this YouTube version of the video. We only went over 5 questions and we did the pillar topics. Now, if you want to get full access to the full version of the video, you can become a SuperfastCPA Pro member. Again, they get access to the full versions of these videos where we usually go over an additional 5 or 6 questions to teach the topics a little bit more in depth and to give a little bit more practice. So make sure you check out becoming a pro member. And the easiest way to learn about and become a SuperfastCPA Pro member is actually by going to SuperfastCPA.com and signing up for our free 1-hour webinar training. In that 1 hour, we will teach you the key ingredients to passing the CPA exam so you don't waste months or even years of your time failing exams. And after you watch that, again, that will give you the key path to becoming a SuperfastCPA Pro member. So check out the webinar, check out becoming a pro member. If you liked this video, make sure to like it and leave a comment. I hope it was helpful, and I will see you in the next video.